Right, so welcome to Module 2, and this is week 2 of our 6-week course, and today we are going to look at understanding the secret world of banks. So the purpose of this module is that I just want everyone to get a better understanding of how banks think, get a better understanding of how they view applications, and so with this knowledge you will see how you can work more effectively to get the most out of banks, and after we cover all the nuts and bolts of Fast Track Mortgage Plan next week, you will get more clarity and see that how Fast Track Mortgage Plan really plays into setting you up to get the best out of banks. And of course you get the great side effect of paying your mortgage off faster, but it also sets you up to get approved more easily when you apply for lending, which will be an important part of everybody's wealth creation process. So with this module, the objectives are, of course, get a better understanding of how banks think, understanding how servicing works and how banks view your income and different types of income to see if you can get approved or not. And for number 2, we're going to look at 4 servicing calculators from 4 different banks so that you can get a bit of an understanding of how they look. Number 3, we're going to look at equity and what this means, and we're going to look at how you can calculate your own equity and usable equity yourself so that it becomes easy for you to understand when you are in a strong enough equity position to take action and apply for new lending. And then number 4, we're going to look at different bank product components. And really, these are the ingredients of our cake, and the cake is Fast Track Mortgage Plan. And I just wanted everyone to understand all the different types of products and different offerings that banks have, and then this will be the ingredients. And next week we will actually make the cake when we'll put all the ingredients together, so that you can see how Fast Track Mortgage Plan works, and you can see how you can use bank products to pay your mortgage down much faster, create equity, and grow your wealth. Right, so number 1, how banks think. So probably the best way to think of the bank's mentality around lending is that they do not believe in YOLO, you only live once. They are very cautious, and they look at things carefully, and they like to consider worst case scenarios. So the 2 core ingredients for new lending is equity and income, and these are the 2 main things that they really care about. There are other aspects around that, of course, such as your account conduct, which is how you treat your bank accounts is another good example. But if you don't get past equity and income, then there's not much point looking further than that, because the door will be closed if we don't meet their needs on those 2 aspects. So New Zealand banks, and talking about the main banks, they're not asset lenders, they are income lenders. That means they're income orientated banks. And the amount of equity and deposit, while it's important, it doesn't determine how much you can borrow. So an example might be, let's say that you win Lotto next week and you have $2 million in your pocket. And because you won Lotto, you quit your job because you're thinking, this is awesome, I don't need to work anymore. So you quit your job, and then you want to go and buy a house which is $2.1 million. So you're going to need a $100,000 mortgage to go with that $2 million that you won at Lotto. So you would think that this might be a very strong situation. Banks, you'd think the banks might say, hey, look, you've got such a huge deposit, we can easily lend you that $100,000. But in that situation, the answer would be no, because the bank would say, well, you still want to borrow $100,000. What income have you got to service that $100,000? And you would say, I've got none, because I've just quit my job out of jubilation of winning Lotto, and they would decline that application. So while the equity or deposit part is important, if you don't have the income, you're not getting any lending at all, and income is going to always be super important from New Zealand lenders' point of view. And of course, continuity of income is important. So this is something that comes up quite a lot with contractors, IT contractors, or government contractors, where they have these contracts that are often only 6 months long, and so banks are very interested in the continuity of income. And so even though it might be in a good contract right now, if it expires in 6 weeks' time, the bank will want to know what is going to happen after that. So this is why they do like permanent positions, which of course are never actually permanent, but anyway. But they like permanent positions because that to them is a good sign of continuity of income. And while plenty of contractors can get mortgages, so that's okay, you just have to play that game right, because if your contract's about to expire, that's not a good time to apply for lending. But if you're about to get if you've just received or just signed a new contract, then that is the best time to apply for some lending. So banks look at worst case scenarios. So you'll see this in the next section when we look at some of the bank servicing calculators. And a conversation that I have quite often is people will say to me, I've done the maths on what the repayments are going to be, and I've checked it against my budget, and I can see that this house is very affordable for me. But what they haven't realised is that the bank looks at worst case scenarios, and so that's why even though it might be affordable in reality, but under bank servicing calculations it might not be affordable, and banks might decline that situation. And so overall, the risk department of banks have a lot of influence, and this is why it is really, really important that we all learn how to play the banking game well, because without the ability to play the banking game well, we won't get the most out of the banking situation. And in New Zealand, we actually are very lucky that we've got strong and stable banks, we've got good interest rates, we've got pretty good terms and conditions to our lending. So these are all factors that we should be grateful for, but we still need to understand how to make the most of that situation, because using banks is vital to us being able to grow our wealth over time. And using Fast Track Mortgage Plan will certainly help with that, because it ties in with everything that the banks do. Right, so let's talk about servicing. So I will go down here and just change to a couple of calculators. So I've created 4 calculators here so that you can see 4 different scenarios, but it's actually the same client that I've used for all 4 calculators. And this is just so that you can see the difference between how different banks will look at a situation. And so this client here, there's 2 adults and they've got 2 children, and they are wanting to buy a $600,000 investment property. One of them earns $50,000 a year. The other one earns $70,000 a year. This figure here, $28,600, is the annual rental income of the proposed property that they want to buy. And this here is they've got a flatmate or a boarder staying at their current house, and this boarder pays $150 a week, which is $7,800 a year. So this is like the income section. This pink section over here is their personal expenses section. If I scroll down a little bit, this is their debts section. So they have a $10,000 credit card limit. Now you see that $10,000 credit card limit takes $300 a month out of their income. Now they don't actually owe anything on this credit card. They pay it off every month. They handle this very responsibly, but just because they've got a $10,000 limit, this means $300 comes out of their income straight away. Okay, so this is their $350,000 existing mortgage that they've got. So you see that these are their current repayments, just there, current repayments. But you see that the bank, which is 2247, but the bank will work with this much higher figure of 2903, and this is an example of how banks look at a worst case scenario. This is the $600,000 lending that they would like to borrow, and this is the proposed repayment amount, but you'll see here that they work with a much higher figure of 4093, so also them applying worst case scenario, because this is what you have to get over to get approved. Out of interest, this rent that they've got up here for rental income, even though we've put in here the whole amount, 28,600 per annum, that gets scaled down usually by 75%, 25% gets taken off. And so even though they're getting that income and the border income they're getting, both rental income and border income is scaled down. Border income even tougher. Usually 50% is only used of border income. So the only income that they actually get to use 100% of is their actual salaries, their actual income. So this little table here in the middle is just kind of like a summary table where we've got assessed income, less their fixed commitments, less their debt servicing, less essential living costs. So this is benchmark costs. So if the figures that we put over here for their living costs are less than this figure, they'll just apply the benchmark figures, and this was less some discretionary living costs. So they're coming up at negative 82, and it's in bright red. So that means that this would be a decline because they are they don't have enough income, or they've got too much debt for their situation. So in this situation, we can of course say, right, we're going to close that credit card, and if we close that credit card, we now get a small pass. I'd still consider that to be a small pass. I'd like it to look stronger than that, but that may get by. And even though really this situation is actually pretty comfortable for this client with the help of rental income, but it's coming up as a fail initially, and we would have to play with those figures in order to get that to become a pass. And the obvious way would be to close the credit card for this situation. Right, so a couple of examples there of worst case scenario: the rental and border income being scaled down, and the repayments on the lending get scaled up. So we'll jump over to let's have a look at ASB. Excuse me. So this is ASB, same client. We're going for 600,000 new lending. There's their incomes. There's their rental income. There's their border income. And this is their existing lending that they've got. That was the 350 mortgage, and this is the proposed lending repayments. So once again, these are bumped up to higher levels. Here's their credit card with 300 taken out. It's basically 3% of the limit is taken out of their income. And then this client here, remember we had 2 adults and 2 kids. So all these figures over here, the 725, the 700, 180 and 650, these are monthly figures that are taken out of their income because they're 2 adults, they're 2 kids, and they are prospective or existing homeowners. So they just apply to this. Apply these expenses essentially to their situation, and it gets taken out. And this was their living cost down here below. So plenty of worst case scenario in there. And so for this monthly servicing calculator, all these calculators are monthly servicing calculators. You can see that they've got an uncommitted income of 871, and basically what this is saying is that they've looked at all the income coming in for the month, less all the expenses going out for the month, and they're saying that under worst case scenario conditions, there is still 871 left over. And 871, around that sort of figure, is sometimes a pass with ASB, and that is sometimes a fail with ASB. So that can go either way, and it depends on how generous or tight they are being at the time. There's been times that ASB has had figures as low as about 240, and if you had 240 or above, you'd get a pass. And there's been other times that you'd need up to $1,000 per month uncommitted income to get a pass. So at the moment, under current circumstances, I'd probably say that this would likely be a fail. If it was a pass, it would be very, very tight, and it is possible. Once again, through maybe closing the credit card, it might be possible, but that's right on the borderline. And certainly, if this was an application that I was doing, I'd want it to look stronger than that. Right, let's jump over to ANZ. So same client, of course, 2 adults, 2 kids. There's their current lending and there's their proposed lending. So ANZ on the calculator here, you can see that they're applying 6.65% to the lending. This is for the current and for the proposed lending, 6.65. And of course, at the moment, the rates are below 3%. So this is more than double actual rates. It would be nice for them to lower these test rates, but they still haven't done that. And there's their incomes, there's their rental income and border income. They're actually using all of the border income, but the rental income gets scaled back, shaded by 25%. And these are the proposed repayments, and here's your credit card again with $300 being taken out, and this is their living expenses. So this is a good example of worst case scenario. Their living expenses came to 2270, but the bank says 2985. Okay, and they'll apply that minimum benchmark figure instead. And this 375 was their KiwiSaver contributions. So at the top here, it'll tell us that they are getting, sorry, not the top, at the bottom, they're getting a bank monthly surplus of 703. And this is a little bit like the ASB one that we just looked at. 703 at different times has been a pass. But because banks are generally a bit tighter and tougher at the moment, I'd expect that to be a fail at the moment. And this would be a situation where we would have to find more income, close the credit card, or maybe reduce the amount of lending that we are asking for in that situation. Because maybe, for example, because we're asking for 600 here, and the bank might say 600 is a bit high, but maybe 550 would be okay, something like that. Right, and then I'll show you the last one is a BNZ one. So the BNZ one I've kept for last because it is interesting. They do one thing different from the other banks, which you'll see shortly. So we've got the same incomes there. Rental income and border income, and these are also shaded. BNZ does 80% of the rental income, and here's the 600,000 that we're wanting to borrow. And this is the part that's interesting. So this is the 350 current mortgage that these guys have got, and the current interest rate that we had with this client for all 4 scenarios was 3.2%. And BNZ is the only bank out of these 4 that will actually use 3.2% for the loan calculations. So all the other banks will apply those test interest rates, which were higher. You'll remember the ANZ one was 6.65, I think it was. But BNZ will actually use 3.2, which is really nice of them. And that means that once we take out the other expenses and lifestyle expenses, we're getting green 116. So they use a different type of index. It's not dollars surplus per month, but anything over their index number of 105 is considered a pass. So at 116, that's actually a relatively comfortable pass. And the other ones, you remember the previous banks were either fails or, plus minus fail. They could have gone either way. But BNZ, this would actually be a comfortable pass in this situation. And really the only difference is that they're going to use 3.2% for that existing mortgage rather than applying a test rate. So you can see that from going through these different calculators that you really have to do everything that you can to make your income look as good as possible. Your expenses are often just dictated by what the bank says the benchmark expenses are, and this is where having lower mortgages really help, because if, for example, this client had been following Fast Track Mortgage Plan, instead of having a 350 mortgage, they might have a 250 mortgage. And that would make their situation look even stronger, which means it's a more comfortable pass, or they could even borrow more money to buy something a little bit more fancy if they wanted to. So overall, you have to sort of play this game of manipulation to get the most out of your situation, knowing that the banks are always going to look at a worst case scenario. Right, we'll jump back to the slides. Right, so how banks calculate equity. So we're just going to look at equity versus usable equity because they are two different things and give us different results. So in this first scenario here, we're going to consider somebody that owns their own house. It's worth $500,000 and they have a $300,000 mortgage on it. So this means that they have $200,000 in equity. Okay, but the usable equity, which is the important figure that we want to figure out, is actually only $100,000. So the way to calculate this is you'd work out what's 80% of the house's value, which would be $400,000 in this situation because that's 80% of 500. And then we would subtract off the existing lending of $300,000, and then you'd be left with $100,000 left, which is your usable equity. So really, all you're really doing is you're working out what's the uppermost lending limit that a bank will give you, which is 80% on an owner-occupied house, and then subtracting off the existing lending to find out what your usable equity is, which is $100,000 in this situation. So how does that change for an existing rental property? Well, let's say there's a $500,000 rental property, also with a $300,000 mortgage, which equals $200,000 equity. So far, exactly the same as the previous page, but in this scenario, the usable equity is actually only $50,000 instead of $100,000, so it becomes less. The reason for that is that you would calculate 70% of the house's value because a bank will only lend 70% on a rental property. So that means 70% is $350,000, and then you'd subtract from that the existing lending of $300,000, and that would leave you with $50,000 usable equity. So one note here, because a lot of future-bound clients are buying new build properties, we'll make a quick comment about new builds. And so a new build are LVR exempt if you're buying one as a investment property. So that means you can do 80% lending at the time of purchase for a new build as opposed to 70%, which is really helpful. But the thing to note is that as soon as you settle on that house, it becomes an existing house. And then from that point on, it's viewed as being an existing house, which means 70% lending, which means you need to leave 30% equity in. So that means with those houses, you have to create a little bit more equity before you can start pulling equity out of that house. So even though it's 80% on settlement, it becomes 70% after that. Right, so while we're doing this, it'd probably be good if everyone got out their phones because and switch to your calculators on your phones, because everyone can go through this scenario of working it out for their owner-occupied home. So everyone can maybe right now just type in their estimated market value of their house, and whatever you think your house is worth. It doesn't really matter if it's too accurate or not, but whatever you think your house is worth right now, and then times that by 0.8, and if you times it by 0.8 or 0.8, that will give you 80% of the value of your house, and then you can subtract off the mortgage that you've got on your house, and the answer that you've got there now is your usable equity. So how to use usable equity and to calculate the purchasing power of usable equity. So that's what we'll look at on this slide. So 100,000 usable equity means that you can purchase a $500,000 new build, or as a rental this is of course, or a $333,000 existing house. So the calculation is if you're buying a new build, you can times your usable equity by 5. And if you're wanting to buy a existing property as a rental, then times your usable equity by 3.33, and that will tell you your purchase price that you can go up to. So obviously the more usable equity, the better, and that's why creating equity is such an important part of being an investor, because a lot of the investors that when I first start working with them, equity is an issue, and I consider Fast Track Mortgage Plan to be the best way of creating equity quickly, so that you have enough equity to buy either the first property or maybe additional properties. Right, so the ingredients to creating equity faster. Right, so some of the stuff will be really foundational for some of these listeners. Some of it will be new, but we'll go through them all because most people are aware of the different components of mortgages and different bank products. But I've found through experience that very, very few people know how to make them all work together. And that's different. That's the difference between a recipe and a cake. Just because you have eggs, butter, flour, and I don't know, whatever else goes in a cake. Just because you have those ingredients does not mean you have a cake. You need to know how to put it together to get the result. So principal and interest versus interest only. So this is talking about the types of repayments. And so the principal is the amount that you owe on a loan. So if you go to the bank and you borrow $300,000, that means you've got $300,000 of principal that you owe. Okay. Interest is what the bank charges to make profit, and they will charge interest on that $300,000, and that's how banks get rich, by charging interest. So when you do principal and interest repayments, it means that you are paying both at the same time. So what that would look like, if you look at my cursor there, basically if I was drawing a vertical line right there, that would be the repayments for year number 1. And you'd see that early on in the mortgage, you're mostly paying interest, and the blue part at the top is quite small, so you're just paying a little bit of principal. As you get down this end of the mortgage, you'll pay a lot more principal and a lot less interest. So the key is, how do we get down here faster? How do we work with more blue and less of the white? Because we want to pay principal, we don't want to pay interest. Interest only repayments means that your loan is not going down at all. You're not paying off any principal, and you're just paying interest, and how much interest you pay just depends on the interest rate at the time. So, or whatever you're fixed into, but a lot of investors do interest only repayments while they focus on paying down their owner-occupied mortgage. So a perfectly good strategy in certain circumstances, but not so good if you actually want to get rid of your debt. Principal and interest payments versus and lump sum payments. So these are really the two ways of paying down your mortgage, because both these methods pay principal. So principal and interest repayments, I consider them to be hybrid, because every repayment that you make is a combination of principal and interest. So you're always doing a bit of both there. And then lump sum payments, of course, are 100% principal, but there are limitations of how many you can do or when you can do them. And we'll talk a little bit about revolving credits and offset accounts shortly. But basically, whenever you put $1 into a revolving credit, this essentially is a lump sum payment. It's the same thing. So that's why if you can use a revolving credit or an offset product well, then basically you can do lump sum payments whenever you want, which is pretty handy. And we'll talk more about those shortly. Right, so fixed loans versus floating loans. So in New Zealand, you can fix a loan generally from minimum of 6 months, most banks up to 5 years. BNZ actually does up to 7 years, but that's pretty unique. And the reason that people like to fix their loans is because it gives people certainty of repayment, because you'll fix in a particular interest rate, which means that your repayment is fixed, and you can basically have that continuity and know that your repayments aren't going to go up, but you can't pay it off early because it's fixed into a particular term. And so there's pros and cons. Pros are you get to know what your repayments are going to be for a period of time, but the cons will be that you can't pay it off earlier while it's in a fixed term. You just have to go with the flow on it. Okay, A floating loan, in contrast, this is a variable interest rate. It can go up and down. It can move around. You don't get any security around what your repayments are going to be. So your repayments can move and go up and down. But you can pay this loan off as fast as you want. And there are certain circumstances where that is helpful to have that feature, so that you can really target a particular loan early, should you want to. Loan hedging. So when I started as a mortgage advisor 5, 6, 7 years ago, loan hedging wasn't that common. It's a little bit more common now. And it's just a way of splitting your loan, or splitting your mortgage, I should say, into multiple loans to spread your risk over different terms. So an example would be you might have a $300,000 mortgage, and you would put $100,000 on 1 year fixed, another $100,000 on 2 year fixed, and then another $100,000 on 3 year fixed. So the reason that you do this is just so that interest rate rises can only affect a third of your lending at any one time, and if you had everything on 1 year fix, for example, if the rates go up after 1 year, then that means all your lending gets affected by that higher interest rate. But if you have a hedging strategy set up like this, then it only affects a third of your lending, and the other 2/3 carry on. So it's just a really way of putting your eggs in different baskets, and a way of having a bit of risk management so that your loan repayments don't go up a lot if interest rates were to change and go higher. Revolving credits are probably one of the most misunderstood and misused bank products. And a lot of people have trouble understanding them, but really they're just a different type of mortgage loan. If you have a $100,000 mortgage and you decide to have $20,000 as a revolving credit and the other $80,000 fixed, then that $20,000 still represents $20,000 of your mortgage, so it is still part of your mortgage. But it's just a different type of loan. Now, the thing that's different about it is that it's a transactional account. So money can be moved in and out of it anytime that you want. And with revolving credits, you only pay interest on your outstanding balance. So if you have a $20,000 revolving credit and you put $5,000 into it, that means you're only paying interest on $15,000. Now, of course, you can just take that money straight out again and go and take that $5,000 out and go and spend it on something, and then you're back to paying interest on $20,000. Okay, so the more money in there, the better. And that way you pay the less interest. And because it's transactional, you can pay your bills from the revolving credit. You can even have EFTPOS cards or debit cards from your revolving credit. So they're quite flexible and functional like that. But what I've found is that the majority of people use these incorrectly and end up paying too much interest. The reason for that is that if you're going to have a revolving credit, you want to have the right size revolving credit. Too small and it's inefficient, too big and you pay too much interest. Right. Offset loans. So offset loans probably only came to New Zealand around about 5, 6, 7, 8 years ago, something like that. So not that long. So relatively new for New Zealand. And they're similar to a revolving credit that we've just looked at, but they are a little bit different to that. So an offset loan is, in the example, this one here on the left, this box, and it is just a standard floating principal and interest loan. Nothing fancy about it, no difference really from a standard floating loan. But the difference is that with an offset type loan, you can link it to different bank accounts that you might have here on the right hand side. And so the more money that you have in these bank accounts over here, it means the less interest you pay on your loan over on the left. So so you can have multiple accounts here. In this scenario, I've got 1, 2, 3, 4, 5, 6, and 7 accounts, but you can have quite a bit more than that should you want to. and that way you can put money into these different accounts and save interest on the loan over on the left. So this method here is pretty good for people that like to keep their money in different pots. So if you've got a heritage with your finances of keeping your money in different pots, and you like having a bills account, and maybe you like having a holiday account, maybe you like having a spending account, then an offset loan might work well for you, because you can just put your money in different pots. In contrast, the revolving credit doesn't work like that. You've just got one big pot with the revolving credit, and all your money's in there. And so that is also one of the reasons that some people struggle more with the revolving credit, because all their money's mixing together, and it's hard to differentiate, what belongs to spending and what belongs to bills and what belongs to the holiday account. So it gets a little bit more confusing for some people. So like the revolving credit, a lot of people do use offset loans incorrectly as well. And this is often related to the size of their offset loan, because once again, if you have it too small, it's inefficient. And if you have it too big, you pay too much interest. So having the right size offset and revolving credit is quite important to get your mortgage as efficient as possible. Right, so it's all about the recipe. So what we've just covered up there so far is just about covering the different components of a mortgage. But knowing about those components doesn't mean that you pay your mortgage off faster. It's how you put them together that makes a difference, and that's what we're going to talk about a lot more next week. We're going to look at the recipes, so that everyone on this course can get a good understanding around their own fast track mortgage plan, and get a good understanding around how you use these components to get the result. Because if you look at your fast track mortgage plan, most people are saving significant amounts of years and interest off their mortgage. And so those are quite life-changing changes, quite life-changing differences. So it really does pay to understand your mortgage, understand the recipe, so that you can make the most out of your situation. So that's all for Module 2 now. We'll go back to the live session, and we'll do a few questions and answers.